In the study guide, it mentions that you need to look at Exhibit 11.8. In this video, I'm going to cover 11.8, but I'm going to wrap it up with 11.9. I think they tie together nicely and provide a more meaningful overview of what we're trying to learn. Okay, so as you know in your reading, that when you see the word contribution margin, that's a contribution margin income statement. And the contribution margin income statement is not for external reporting. It's also called not GAAP or non-GAAP. It's for internal users. Because of the contribution margin, we're a contribution margin income statement, and creating this statement, we can calculate cost volume profit analysis, break-even analysis, do what ifs on different formulas. What if we want to make a target profit? What is the volume needed? We can also calculate the margin of safety, the operating leverage. There are so many benefits for internal users for the use of the contribution margin. Now keep in mind that we have two categories in the contribution margin, all variable costs and all fixed costs. Okay, even if something's a mixed cost item where it's got a little bit of fixed and a little bit of variable, we need to separate the fixed and the variable and put the fixed part with the fixed cost and the variable part with the variable cost. So the contribution margin income statement. This is two companies, contribution margin income statement. Bragg has a contribution margin of 140, Biltmore 80. Bragg has a lot of fixed cost, 120, while Biltmore is 60. Both have a net income of 20. Interestingly, though, sales revenue is the same. So how do we think this through, and what does this mean as far as, okay, if we're going to grow profit or we're going to make some changes in the decisions? Let's look at the next exhibit. We can calculate the magnitude of operating leverage, which is contribution margin divided by net income. And leverage is the key word here. And this isn't like debt leverage where we're putting a little bit of money of our own down, let's say $5,000, and now we can live in a $100,000 home. We didn't have $100,000, but because we did have $5,000, we leveraged that, took on debt, and now we live in a home that we own. I use 100,000. Used to be like, ooh, starter homes don't cost that much. Now we still say it, but we're thinking, oh, that's cheap, and starter homes aren't that much or that cheap anymore. When I used to use $100,000 for that example, starter homes were not that much, and that's not been that long. Prices of homes have gone up. Anyway, back to the task at hand. Bragg companies operating leverage, $1.40 divided by 20 is 7, and Biltmore Company, 80 divided by 20 is 4. Let's go back. So that would be contribution margin, 140 divided by 20, or 70%, which is really a large leverage. Or 80 divided by 20, which is 40%. That's not a bad amount of leverage either, but comparison, right? One's bigger than the other, 7 versus 4. All right, so excuse me. Let's say sales increase by 10%. What would the impact be because of this operating leverage on net income? Well, we're leveraged, so it should benefit us to have on the bottom line. So this kind of operating leverage I like. I like this kind of operating leverage. Now there's other conversations we could have and schools of thought we could have about debt leverage. It's the same concept. I just think that, and I came from lending, we were highly leveraged, okay? So every dollar we lent out was basically borrowed. So, I lived with it and it was fine. Company's fine. I'm not there anymore. I still own a lot of stock. They're doing fine. They better be. I hope they're doing better than I was when I was there. I don't care when it comes to my money. Good for you. I'm glad you're better than me. Make me money. But That's debt leverage. We're talking about operating leverage here. And I like it. I think the better you can be at this, the better things are. But at the same time, there's debt that can be used to help the company also. So this is just one part of the conversation, only one. We're only focused on operating leverage. So Bragg has a 10% increase in sales revenue. Biltmore has a 10% sales increase. Both end up at 220. They both start 20 for net income. Where do they end up? Bragg's a whole lot more, 34 versus 28. Why? And it's the leverage because of that contribution margin. That contribution margin, once you break even, in other words, your contribution margin equals fixed cost. Once you clear that, the more you clear it, the better your bottom line is, the better your net income is. So mathematically, it was 7 for Bragg, or 70%. So 20 times 1.7 is 34, or 20 plus 70% of 20, or 14 is 34. Well, Biltmore was 4. So 20 times 1.4 is 28, or 20 plus 8, 40% of 20 is 28. So that leverage, that operating leverage that was in favor of Bragg and resulted in a higher net income. Operating leverage, that was the conversation here for these two exhibits, 11.9 and 11.10. I said 11.9 at the beginning of the video. I was thinking there was just one here. I didn't realize this was 11.10 also. So one of the advantages, again, to recap of calculating the contribution margin, is that we can do a CVP analysis, break-even analysis, calculate target profit, margin of safety, operating leverage, calculate the magnitude of the impact on increase of sales for net income. Well, that's the things that internal users can use to make decisions for their company, informed decisions based on data. This concludes the video covering exhibits 11.8, 11.9 I was saying only, and then I'm going to add 11.10 now. If you have any questions, please email me.